Imagine thinking you just got the financial break you've been waiting for, only to realize later it came with a hidden cost. That's exactly what could happen if the Federal Reserve decides to cut interest rates this week, and investors aren't thinking about the bigger picture. Let's talk about why everyone's watching the Fed right now, what a rate cut might really mean, and why history tells us to be a little more cautious than excited. So here's what's going on. There's been a ton of chatter lately about the Federal Reserve possibly cutting interest rates. For months, Wall Street's been playing the guessing game. Will they? Won't they? Now, with inflation cooling a bit and economic growth looking steady but not spectacular, a lot of people are betting the Fed is ready to pull the trigger. At first glance, a rate cut sounds like good news. Lower rates make borrowing cheaper, which can boost everything from home buying to business investment. Stock investors in particular tend to get excited about rate cuts. Historically, lower rates often juice the stock market, and we all remember what happened during the COVID crash. Once the Fed slashed rates, stocks powered back in a hurry. But before you pop the champagne, let's pump the brakes for a second. The folks at the Leuthold Group, a well-respected investment research firm, are cautioning investors to look back at what happened in 2007. That year, the Fed also cut rates in response to signs that the economy was slowing. And while the market initially cheered, that move turned out to be the calm before a very big storm, the financial crisis of 2008. So what's the connection? The idea is that while a rate cut can provide some instant relief, it can also be a signal that the Fed sees trouble ahead. Think of it like someone in a boat starting to bail water out. It might keep you afloat for a while, but it's also a sign that the boat is taking on water in the first place. In 2007, the Fed's rate cut was meant to cushion the economy from the growing problems in the housing market. But instead, it ended up being an early warning that something was seriously wrong under the surface. Let's dig a little deeper into why rate cuts are such a double-edged sword. On the one hand, they lower the cost of borrowing across the board. That means lower mortgage rates for homebuyers, easier loans for businesses, and in general, a little more breathing room for anyone carrying debt. You'd think that would give the economy a nice boost. But on the other hand, when the Fed cuts rates, it often means they're worried about a slowdown. Sometimes markets interpret that as a red flag. Wait, what does the Fed know that we don't? In fact, data shows that since 1980, the S&P 500 has actually dropped on average in the year after the first rate cut following a cycle of hikes. Investors who pile into the market hoping for a quick bump sometimes end up disappointed, or worse, caught off guard if things go downhill. There's another layer to this too. The current situation isn't exactly a mirror image of 2007, but there are some similarities. Back then, inflation wasn't the problem. It was more about housing and credit markets cracking under pressure. Today, inflation has been the main concern for the past couple of years, and only recently have we started to see it cool off. But the risk is, if the Fed cuts rates too soon, it could reignite inflation or signal to the market that the Fed's worried about growth, which could spook investors. Let's not forget, we're still dealing with some pretty big headwinds. Corporate earnings are decent, but not spectacular. The job market is solid, but there are signs it could be cooling. And globally, things are a bit shaky, with geopolitical tensions and slower growth in places like China and Europe. A Fed rate cut might help ease some of that pressure, but it's not a magic bullet. The Leuthold Group's warning is really about managing expectations. They're saying, hey, don't just assume a rate cut is always bullish for stocks. In fact, sometimes it's the opposite. When the Fed shifts from raising rates to cutting them, it's often because they're trying to get ahead of a slowdown that's already taking shape. And if the economy does tip into a recession, stocks can fall even after rates are cut. We saw this in 2001, 2007, and even in the early 90s. So what should investors do? First, keep your cool. Don't chase headlines or make big moves based on what you think the Fed might do. Instead, focus on your long-term plan, diversification, quality investments, and a clear view of your financial goals are more important now than ever. It's also wise to pay attention to what's happening beyond just interest rates. Look at earnings, job data, and global trends. And remember, markets don't move in a straight line. There's always a push and pull between optimism and caution. Rate cuts can spark rallies, but they can also be a sign that rougher waters are ahead. If you found this breakdown helpful, please hit the like button, drop your thoughts in the comments, and don't forget to subscribe for more clear-headed takes on the markets. As we wait for the Fed's next move, ask yourself, are you preparing for what could go right or what could go wrong? Sometimes the best investment strategy is to expect the unexpected.